G'day expats and welcome to another episode of Expat Chat, episode 103 today, and joined by my mate and colleague, Mr. James Ridley, Managing Director for the Australian office and Guru of the Asia and the Americas. G'day, mate.
G'day, Brett, and what a terrific way to bring me in. And those who are joining us today on YouTube, you can see our faces. Joined as always on my left-hand side, Brett. I'm looking over you over here.
Yep, there we go.
Brett Evans.
I'll have it
He's
all way,
the
actually.
Managing Director, Founding Director for Atlas Wealth Group, and the Managing Director right now for the EMEA region, Europe, Middle East, Africa's. Brett, how is the sandpit treating you on this lovely morning on your side?
Mate, busy. It's one of our busiest times of year. I think people realise that the end of the year is approaching rapidly.
Isn't it?
The Middle East is awash with Aussies. A lot of folks coming out of Oz, and interesting narrative. Pre-COVID, it was always about go to the Middle East for 2 to 3 years, make some bank and head back. People are coming out and saying indefinitely. And it's not just one or two, it's everyone. And I think their cup is full with Australia, and they're going to greener pastures.
Yep. Yeah. I think amount of people I'm speaking to that are heading over your way, especially Saudi way, just in droves at the moment. So there's obviously a huge push there from the Middle East, Saudi side. So and it's hard to believe, most professional firms will start to wind down, shut down just around 18th, 19th of December, and that's only 6 weeks, 7 weeks away. So it's hard to believe that there's only less than 2 months on the dial for the remainder of the calendar year, and then it's the reset button. So yeah, if you're sitting by, not sure whether to take control of your finances, not long until a new year, then hit the reset.
Well, if you want to start 2024 with everything in order and your ducks lined up, do it now.
Absolutely. And today's episode, mate.
Yep, today we're going to run through a bit of Q&A from the Facebook group. So for those folks on the podcast who aren't aware, we have a Facebook group called the Australian Expat Financial Forum, 2,600 or something, maybe, roughly, members on that group. And every month we chuck up a Q&A post, come and give us your questions that are keeping up at night. So, mate, let's jump into this call. Let me just quickly smash out the disclaimer. All the information we're going to have a chat about today should be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need personal advice, reach out to us.
Absolutely, mate. Let's jump into it. I mean, I'll read out the first question, and shout out to Alex. Thanks for dropping this in the Q&A. Great question here. And read it as it is. We're sitting on a prior year capital loss, but expecting some gains this financial year, capital gains. So they're obviously selling an asset, and they're going to have a capital gains tax event. If we offset the gains against the losses, we will not pay tax in Australia, but we'll still be liable for tax in France. So now bringing in the other jurisdiction. Offset against taxes paid in Australia in such a case none. Can we instead elect not to offset the gains, pay the tax in Australia and have the offset in France? What a great question. So summarising this question, they're going to have a capital gains tax event in Australia. They've got carry forward losses on their Australian tax return. They want to know whether they can keep the losses at bay, pay tax on the gain, based on the tax they're paying on the gain in Australia at 32.5% because they're a non-resident. But can they then use the tax credit and bring it over to France? It's a really good question, but often you can't usually elect to just, I suppose, forego capital losses. That's their purpose. And when you look at most accountants, when they actually do their tax workings, it's a case where you'll have the gain, you'll have your carry forward capital losses, which net it off or reduce it, and then you'll have your net capital gain, which is taxable. I've literally just seen an email come through from a client about a property disposal from the 2023 financial year, and usually you can't elect to not use capital losses. I'd be very surprised. That's right. There are certain categories of capital losses depending on the type of asset, and that's sort of getting into collectibles and other things. But it's very rare that you can just keep a loss there and choose to not use it. If you've got income, which is assessable, but you've got a loss, you usually reduce the loss each year and then you pay the tax. So in this scenario, I don't believe, there's probably more information that we might need to get out of that situation, but I don't believe you will be able to keep the losses at bay without using them. I think it's a case where gain, losses, and then there's not going to be a tax credit, unfortunately, on the French side. So that's the drawback of that scenario. But that's obviously the gap. That's the gap which can be created by different tax rules and treaties.
I mean, it is, and I think people have this sort of misnomer that the DTA is all encompassing and all empowering and all protecting, but it's, we see this on a daily basis. There are gaps in the DTA, and this sort of example is one of those ones. Unfortunately,
That's right.
You can't, move the mountain to another side of the river. It really comes back to, unfortunately, having to pay tax in France, which is essentially means he's getting double tax, but he's not. That makes sense because he's not paying tax in Australia, but then he's using the losses. So unfortunately, Alex, can't help you there on that one, mate, unless you find something different, let us know. But from our understanding, you have to use those losses as those gains accrue.
That's right. Yep. Moving on to the next question. I'll throw it over to you, Brett.
Yep, from Helena. My pension/savings are still in Australia. I didn't transfer because of the poor exchange rate. I'm really confused on whether it's better to leave them there. I'm now living in the UK. Mate, what's your comments?
Well, I mean, drilling down on exchange rate, I think £1 is $1.90 right now. So the exchange rate has gone further out of her favour. Now, I don't know when it would wind back. Also consideration around how the UK might tax a withdrawal from your Australian super fund. I'm assuming that's what she means by that, pension, Australian super. I mean, Brett, obviously the UK side, that's more your side, but it's not typically tax exempt in the eyes of the HMRC. It's typically going to be a taxable transaction. There's ways you can navigate that, but it's often a case where based on this situation, it's really just going to depend, okay, the exchange rate isn't great for converting AUD into pound. Are you in an okay position to keep yourself afloat whilst you're over there? And then wait till the exchange rate changes. But, who knows when the exchange rate's going to change? There's a lot feeding into that. What's going on in the global economy right now? What's going on with everyone's central bank in terms of our cash rate? Is the cash rate decision that's happening on Melbourne Cup Day in Australia, is that going to, move the needle a little bit and raise the value of the Australian currency? I would say maybe a little bit, but most currency markets have probably actually already built that in already. So it's a tough question, not one that's easily answerable.
To me, I think you go high level. Does she need to move the money? And the reason, when we had these, discovery calls with Australians who reaching out to us for the first time, normally my first go-to question from is, where do you intend to return or retire to? So if it's Australia and they're only in Helena's only in the UK for 5 years, there's nothing wrong with leaving that money in Australia, investing it, and generating return from that. She says she's now living in the UK, but we need some more context as to what that looks like. When she refers to it as a pension, maybe she's a British expat that worked in Australia and has now moved back to the UK. That's a different story. In that case, now we're talking about preservation rules with super, that sort of stuff. It gets a bit more complicated from there. So I think, Helena, the two questions I have for you, probably not answering your questions, is where do you intend, what's your intended travel plans or domicile plans in the foreseeable future? If you're just going over the UK for 2 to 5 years, there's nothing wrong with having that money stuck in Australia. If you are returning to UK indefinitely, then you've got an issue, and there's actually a great blog article on our website, www.atlaswealth.com, where we talk about the tax implications of drawing down an Australian super account in pension phase into the UK. So, sorry, Elena, couldn't really answer the question there, but probably need a bit more meat on the bones when it comes to your situation and what that looks like.
100%. Need a bit more context. Jumping into Sam's question. Oh, good question, Sam. So living in the US, do I need to pay tax on Australian super in retirement? So complex issue, still no definitive answer, I believe. I'm new to this group, so wanting to know what prevailing wisdom is. Well, I mean, Sam, if you're talking about US tax drawing, and you're talking about in retirement as well. So let's assume you're drawing an income stream from your Australian super fund, and do you need to pay tax to the IRS on that? I'm going to say yes. Typically the IRS, if you're residing in the US, one, if you're a US tax resident, it's taxation on a worldwide basis. If you're a citizen, same. When you look at our double taxation agreement, between Australia and the US, there is no carve out for Australian super. So typically it can be treated as some sort of foreign asset and some sort of foreign trust, typically. The makeup of that trust is going to be dependent on, the type of contributions that have gone in, earnings. It's essentially a bit of a blender. And then, your accountant will be able to pull it apart and tell you what's taxable, what's not taxable. But if it is just a straightforward account-based pension, you're drawing an income from it, you'll need to declare that on the US side as foreign sourced income. In this situation, because our super is tax-free when we're drawing a pension, which is great, it actually means there's not really a tax credit that you can use to take across to the US side. So probably not a drawback of the situation, but just a case where no tax credit that you can actually use. So I would say in this instance, based on our experience and our colleagues over in the US tax accountants, it would be something you would need to pay tax on, or at least very least declare as an income to the IRS if you're retired in the US.
And I think the other one too, and this is a big warning, just not only for Sam, but everyone else in the US as well too, and I've seen this in the past. I mean, as I don't really get involved in the US stuff now, that's your bag, but when I used to have a Make America Great hat on, when I was looking after clients in the US, I saw a couple of people, their way of getting around this was to do a full drawdown of super. Don't do that. Because two people I met, one did 600,000 and one did $1 million. Suddenly the IRS turned around and said, "Oh, that's accessible income, the 600,000, $1 million bucks. There we go. There's your tax bill price."
Can't be undone either.
Exactly. So I think it's a pretty good answer, mate. And I think the US is we always joke about them being the original founders of the Flat Earth Society for Tax. Super's a convoluted one for expats to the US, and you just need to get advice on that, because certainly it does become more complicated by working under Uncle Sam.
100%. And I mean, we'll jump into the next question, another one from an Alex, and this is around credits paid for tax in Australia versus credits for tax in other countries. I'm going to paraphrase the question. It's essentially, how do you validate deductions that are ordinarily treated as a normal tax deduction in Australia versus if you did the same kind of deduction in another country, which isn't sort of recognised, and there's a tax gap there. So the hypothetical is making a contribution to super and getting a tax deduction in Australia for it, but then your foreign country not acknowledging that contribution as a tax deduction. So then you're having to treat it as income, and essentially you're not getting that tax benefit. It's all going to come down to, I suppose, where you're residing and the country's jurisdictions. To give you a sample or an example of that, I know that some US accountants will take the tax credit that's received within an Australian super fund, so the tax that's being paid there, 15%, and they'll use that as a tax credit in a US resident's individual tax return to offset some of the gains or growth within the fund that they might have to pay tax on to the IRS. So that's an example, but it's not sort of a one size fits all. Some deductions that you'll get in Australia, you're not going to get on the other side. Negative gearing as an example, where you've got, say, a property creating an income loss. Some countries don't acknowledge what the hell negative gearing is. They don't even acknowledge depreciation as a deduction in some. So that's a really important one, and that's probably a gap in accounting principles depending on the country.
Yeah. Unfortunately, in a perfect world, everything lines up across borders, but it doesn't in the real world. So I always say to clients, you're never going to get a perfect result, but if you can get the most optimized result for that scenario. And this not only just on tax credits, but on a lot of things as well too. When you look at income streams, some countries will treat a capital return differently to a income stream. So
that's right.
For those who are looking to retire, don't turn your pension on, just do a lump sum drawdown and take that money as tax-free. And all different states, all different countries are different in how they view things. So just don't jump on that plane and assume, because it doesn't work out well for a lot of folks.
That's right. And last question for you, Brett. I'm going to throw it over.
Yeah.
My Australian bank, Dave, shout out. Thank you for dropping that question in. My Australian bank is asking for my foreign tax number for me to register as a non-resident for tax purposes, but I have no idea where I would get that from. I'm living in the Kingdom of Saudi Arabia at the moment. Brett, how and what should he do?
Mate, this is a common one for especially folks in the Middle East. And I'm actually, as I'm talking to you right now, trying to do two things, but folks, I am a male, so I apologise that I may not have the ability to do two things at once. When you do these declarations, it all comes back to the what we call the Common Reporting Standard. So virtually they want to know trackable. When you move to Saudi, they realise you're Australian, they'll ask you for your Australian tax file number, and this is what's happening in reverse. Where the issue is in Saudi, they don't provide a TIN, tax identification number, unlike, say, United States or UK or, a lot of other countries. So when you're doing a declaration, there's a tax information section. I just found it. There you go. I can do two things at once. Just don't tell my wife. When you go through and answer the questions, it says, is the individual tax resident in Australia? And obviously you'll tick no for that question. And then it says, is the individual tax resident in another country? Yes. And you'll get, normally the standardized form is three options. So you get to put your up to three countries down, and it says country, TIN, and that's your tax file number in Australia or your other ones, in the US and stuff like that.
Yep.
And it says if no TIN, list reason A, B, or C. So reason A, the country of tax residency does not issue TINs to tax residents. Reason B, the individual has not been issued with a TIN. That'd be more like a case when you've just moved to a country and you haven't got it yet. Reason C, the country of tax residency does not require the TIN to be disclosed. Never met a country in that scenario. I'm sure if we dig deep, we could find it, but you and I have got better things to do. So in the case of people moving to Middle East, like UAE or Saudi, we won't have TINs because we don't pay personal tax. So therefore, you would select reason A. So you'd write in the country, Saudi Arabia, TIN, you leave it blank. And then in the last column, where it says if no TIN, list the reason, you'll put in there the letter A, the country of tax residency does not issue TINs to tax residents.
Yep, absolutely. And I mean, I would say that's pretty common with a lot of those Middle Eastern countries. They don't issue TINs because and I think one of the questions always confuses, I think, a lot of Australian residents where it says, are you a tax resident of another country? And I think a lot of people that are in the middle is because they're like, oh, there's no tax here. It's tax-free. So am I a tax resident of this country? Well, you are. You absolutely are, even though they don't levy any tax on your personal income. So that's sort of, I've seen one that has confused clients in the past just because they're asking that question around tax.
And it's that ordinary definition of what a tax resident is. And it's, in the case of taking the Australian version and applying it elsewhere, the resides domicile 183. Most countries have a very similar sort of residency test in that regard. So, virtually, even though you're not paying tax, you just go and follow the same process. Have you lived in the country for greater than 6 months? Same principles apply, even though you're not paying tax at all. So, mate, I think we wrap it up there. So thank you very much to Dave, Alex, Sam and Helena for chucking your questions in there. To people on the podcast who are not members of the Australian Expat Financial Forum Facebook group, jump on. We're pretty friendly. For us, it's meant to be a repository of information, of everyone sharing ideas and the problems they're going through and just helping everyone sort of take away the friction for managing their finances. Bit of housekeeping. Thank you to everyone who attended the online webinar last Thursday with Ben and myself. We had over 300 registrants, which is fantastic. And hopefully everyone got a lot of information, got a lot of value for your time there. So we've got a few more coming up. James, I think you've got one with Jeremy coming up as well, and as well as another one in the US.
That's it, mate. We've got the final webinar for that property series that we've been doing. That's coming up, and that's a couple of weeks away still. We've got one specifically with a US accountant. We'll actually do that as a two-parter, but there'll be shorter webinars just based on our calendars. That'll be terrific for those that are just heading over the US or you're already in the US, because it is going to be December, it's going to be tax time. So it's really important that you're arming yourself with as much information. That way, when you go into tax time for the US side, you're confident. So listen out and look out for those ones that'll be going out on the socials.
I'll also put a link in the description below to our events page where you can see everything coming up as well too, so people can jump on and register in advance.
Sounds great. Thanks for stopping by, guys.
Right, mate. I'll catch you on the next episode.
See ya.